Good morning. We have to see this income tax theory law on practice 1. That is unit 2. This unit 2 we have to see the income from house property. This is the one head of income. Here we have the 5 heads of income: income from house property, income from salary, income from business or profession, income from capital gain, income from other sources. These are the 5 heads of income. Here we have to see the one head of income from house property. First of all, we have to see the meaning of house property. The annual value of a property consisting of any building or land apartment that of which of the assessee is the owner is chargeable to tax under the head income from house property. Here the person is having the asset, having the property, that's any building, okay, that should be pay the tax. And then section 22, any income from houses, buildings, bungalows, godowns, etc. are to be assessed under the head income from house property. That is, income from house property is equal to annual value of a property minus deduction under section 24. Here we have to see this annual value of the property. How to get in the annual value of property? First of all, we have the municipal value and fair rental value, whichever is higher, and then we have to get in the answer, that is standard rent, whichever is lower, and then we have to compare we have to get in an expected rental value, and then we have the actual rent. From the actual rent we have a vacancy period, we have to deduct from that, as well as we have unrealized rent, we also deduct from that. Finally we have getting the actual rent, and the actual rent we have to compare from the expected rental value. That's whichever is higher we have to getting is a gross annual value, and then we have municipal tax, we have deduct, okay, municipal tax paid by the owner we have deduct, and finally we have to getting the net annual value, that is the annual value of the property. And minus deduction under section 24. We have two deductions from 24. One is a standard deduction at 30%, okay, from the net annual value. Another is interest on borrowed capital. That is, interest on borrowed capital is, we have the pre-construction interest and post-construction interest, and pre-construction period is also we have to calculate it, okay, for finding that. And then we have the house property section 23 is we have the segregation of let out to tenant. That is we have the house, we let out to the tenant. That is the purpose of residence or business, whatever it is, that is comes under income from house property, as well as there is a own residence, it is comes also income from house property. Here the assessee, the owner is used for stock in trade, this owner is used for business or profession, thus is comes under heads of business and gains of a business or profession. Here we have say the different valuation of a property. Here the different valuation, we have seen the municipal value is the valuation of property made by the local municipality, and fair rent value is the valuation of property made on the basis of valuation of a same type of a property, size, specifications, etc. in the same locality. That's a value, that's a fair rental value. There is a nearby the spaces, like the areas differ. Standard rent is the valuation of property made on the basis of the rent determined by the Rent Control Act of the concerned state. It's determined the standard rent. And actual rent receivable means the valuation of property made on the basis of the rent received, the receivable from the tenant. Actually, what is the amount to receive from the tenant? That is given as the actual rent received. And then what is annual value? Section 23. It is a value for which a property can be let out year to year. Okay, let out from year to year. So here, how to determine to adjust the annual value under section 23 subsection 1 for let out property. If the property we have let out, and that we have to get in gross annual value, after the steps we have to adjust, already said, okay, whichever is higher and lower we have to get in finally the gross annual value. So from this gross annual value we have to get in municipal tax, and this municipal tax, okay, and that we have finally adjusted annual value. In this adjusted annual value there is a net annual value is also getting, okay. Here how to determine income from house property for let out property, okay. Gross annual value of the property is given, less municipal tax, we have to getting is a adjusted annual value or net annual value. From that we have deduction under section 24, I just clearly explain standard deduction at 24, that is a 30% of standard deduction is getting from your net annual value. And then interest on borrowed capital, we have the getting, that is a pre-construction interest and post-construction interest. We have getting the total deduction from that net annual value, that is adjusted annual value. We have to deduct it. Finally, we have to getting the income from house property let out. This is a way to determine the income from house property to let out house property. Okay. Next, we have the self-occupied. If you are self-occupied, first of all you have to listen. The self-occupied means your own residence. If you have the own residence, you have to pay the tax or pay the rent. You have to pay the tax, but you don't pay the rent to your own residence. That's why here there is adjusted annual value or the net value. It should be nil. There is no any rent you have to pay. That's why there is no comparison. Nothing. It's simply have nil. And reduction 24 is there. Interest on borrowed capital under section 24, subsection B, that is there. And we have only the borrowed capital we have to done it. And the amount we have to put it, there is no any income from the self-occupied. That's why we have to showing the loss from house property, that is self-occupied. Here the determination of gross annual value of a property. That's a property is the step 1 is there. Determine reasonable expected rent under section 23 section 1 subsection 23 section 23 subsection 1 under subsection A, and how to take the highest between municipal value and fair rental value. But the subject or the to maximum of, that is, it should not exceed standard rent. Here the result is the figure is